Good afternoon, everyone, and welcome to Stock Market Today. It's Justin Nielsen here, and again, I'm joined by Ed Carson while Allie is off in Vegas for the CES show. It's January 5th, 2023, and we're going to check out what happened in the market today. In addition, Ed has some stocks that he's going to cover, analyze a little bit on UTHR, United Therapeutics, also Train Technologies, ticker symbol TT on that one. And we'll also take a look at another one of those healthcare insurers, Cigna, CI, down quite a bit. So we'll take a look at those. First, let's go ahead and take a look at the indexes. It was another rough day in the market. The S&P 500 was down 1.16%. The NASDAQ composite down 1.5%. Dow Jones Industrial Average down about 1%, and the Russell 2000 also down about 1%, maybe 1.1%. So, Ed, another day of economic data and another reaction by the market. Has anything changed in your mind?
I don't know if a whole lot. But the jobs data is coming in stronger, and that's just not what the Fed wants to see. It's not what the market wants to see. We're coming in on the jobs report. The market might have. Look, if it's a team jobs report tomorrow, everything might be forgiven, kind of thing, and everything goes up. But people are obviously anticipating because we keep seeing strong hiring. We still keep seeing robust wage growth, and the jobless claims were weaker than expected. ADP was strong. Employment survey was stronger than expected. But from a technical perspective, we're still in the range. We sort of came off some levels. Like if you look at the S&P 500 here, we're at the 21-day line, got up there, and now we've fallen back. It's just clearly that's an area. A lot of the major indexes hit resistance at the 21-day and maybe other levels. So until that happens, you really don't want to be doing much. You want to get ready because There's a lot of stocks that are setting up, but it's like get ready, get set, and wait is pretty much what probably what you should be doing. Maybe not for much longer, or maybe it could be weeks or months. We don't know right now.
But yeah, as you said, hey, that jobs report tomorrow could be a catalyst for some of these setups to actually move. But we have been in that range. In fact, on IBD Live today, we were talking about that. Harold Morris brought up that he was even looking at the 5-minute chart and just seeing how we had been trading in this range for a while, and you really kind of expect it to break one way or the other. And at this point, you don't know which way that is going to be.
Yeah. And that's what's been going on for several days, and we'll just have to see how that goes.
Right. So again, I think you said it already. It's basically sit and wait. So the S&P 500, is still trading below its 200-day line, its 50-day line, its 21-day line, and its 10-day line. So basically, it's down below everything. But to its credit, it has stayed above that recent low, that reversal that we saw about a couple weeks ago. So it's as long as it stays above that level, it's not broken down yet, because once it breaks below that level, then you have to start looking at, okay, what's the next level of support, and how much further down do we go? Do we challenge those ultimate lows just below 3,500? What about the NASDAQ? Is the NASDAQ any better?
It's worse.
Yeah.
It never got to its 21-day line on either one of these days. So it's the weakest of these indexes in that regard. It's sort of, it's not too far from those lows. It hasn't undercut. It's still in that range. It just had a bigger drop from here. It's just been weaker. And if it does undercut these lows, this was a closing low for the bear market. This is pretty low. It would still have a little bit more, but really, it would not be shocking to see a bear market low if there's a sell-off tomorrow on the jobs report. If we 2%, 2% plus, that wouldn't be, unreasonable. So we could easily undercut the bear market intraday low. So definitely weaker. All sorts of growth stocks, the mega caps, and not just the mega caps, but just all over the board. Just a lot of weakness in growth, really, since late 2021.
Right. Yeah, absolutely. And so now we've been talking about the Dow Jones Industrial Average as being the leading index for a little while, but now that one's struggling below its 50-day moving average line, can't quite seem to get back above it.
Yeah, it almost got above its 21 and 50-day lines both days here, has been unable to do it now. This was sort of a range, and now it's getting to the lower part of it. It's below those levels, so that's a little disappointing. Again, all it would take is one good day, and it all of a sudden starts looking a lot better. And that's what's so difficult about this market. A lot of stocks are doing the same thing. A lot of sectors are
Mm,
doing that, indexes. So it's like, oh, there it is, there it goes. And then it can quickly just turn around. And we just don't ever see that momentum where it's that day in and day out, or at least most days and most days out, where you're seeing that uptrend. And it just makes it very difficult to trade, because every time it seems like something is going well, it'll just turn right around and reverse and maybe undercut the lows from a few days earlier.
hmm Let's go ahead and round out the discussion and just take a look at IWM. This is the iShares Russell 2000 ETF, tracking the small cap index. Um, anything to glean from this? I mean, it's staying above the October lows so far, but it's below all of its moving averages as well. And to its credit, the October lows at least kind of stayed above, right around the June lows. So this one really didn't go lower. Is that a positive?
That was a positive, I'd sort of say, because it felt like the small caps held up a little better and then were sort of leading. They were the first, or among the first, along with the Dow, to get above the 200-day line. But since this part, it's been sort of lagging. It's been trading more like the Nasdaq. So, right now, it's just there's really not really a whole lot of strength in this market.
Yeah. So you mentioned the mega caps and the effect that those have. Certainly, one of the things we've been looking at more recently is the RSP, which is an ETF that takes basically the S&P 500, and rather than applying a market weighted, to that index, it's applying a equal weight to the index. And so this is, unfortunately, got right to that 200-day moving average line, was looking better, but now that it's getting resistance there, is it basically saying, hey, there, everything is going down, not just the mega caps?
Yeah, I mean, it's in a little bit better strength, better position, because it did get above those levels and now it's falling back, as opposed to getting near those levels and falling back. But it's just
Right,
there's more of a trend here. It's like it's sort of range bound, but it's sort of vaguely trending higher.
right.
So
There's at least some higher lows.
there's some higher lows. I mean, it's like, yeah, so it's a little better, but it's also just at the edge. It's not like if you take away Microsoft and Tesla and some of these mega caps, that everything, looks great.
Yeah, absolutely. Now, yesterday we talked a lot about the 10-year yield, the bond market, and how the Fed has really kind of got its eye on that, and kind of having its desires for what it wants to see the bond market do. Yields seem like right now the 10-year yield is struggling to get back above that 50-day moving average line.
That is, but that's not just because of, they're easing off on inflation concerns. It's also fears of recession,
Mhm.
because the 2-year yield rose several basis points today. So like this one did hit resistance and basically was flat, up 1 basis point. The 2-year yield, that one actually rose 6 basis points to, I think, 4.45%. The 3-month rate is even higher. It rose like 10 or 11 basis points, somewhere in the 4.6 range. So that's inverting. Those are more closely tied to Fed policy. The big yield inversion, where the short end is higher than the long end, those are sending recession signals. So while on the one hand you'd say, oh, that's good, the bond yield didn't rise. On the other hand, that the way yields are reacting overall,
Right.
not really ideal.
Yeah, you can't just go by one of them. You have to kind of look at the mixture of different time frames. Now, you mentioned that yield curve inversion. That's something I feel like we've been talking about for so long, and everyone points out to the statistics about how accurate it is in saying that a recession is coming. But what about the timing? How far should we expect? I mean, because I feel like talking about the yield inversion for a long time.
We have been, and it isn't supposed to happen right away. And
Mm,
maybe this one's different. I mean, this one's just an odd situation, um, partly because banks are better capitalized than they were, in the wake of the great financial crisis. The job market is still strong. I mean, it is an odd economy out there. I mean, it's not. There's a lot of weird fluxes going on. Maybe China will come to the rescue and it'll start
mhm.
growing again. And I mean, there's a lot of uncertainty. Nothing seems to know. I don't think there's a lot of uncertainty out there, and it's not just I'm uncertain, you're uncertain. The markets don't seem to have any sense, and they don't even seem to be connected to each other anymore. So
Yeah.
they're just very tough, and this is why you don't try to predict. I mean, this is like a great example of why you don't try to predict. You just try to let's see how the market's doing. What is the market showing right now, rather than trying to say, well, what's the market going to do 3 months from now, 6 months from now?
Right. And for a lot of people, it's, the question keeps on coming up. Oh, was this priced in? Was this priced in? At a certain point, you just have to look at what the market is doing on a given day at this point, it
Yeah.
seems like, because and what the next headline is that you have to worry about, like we're talking about the jobs report tomorrow. What about the dollar? A lot of times we use UUP to kind of represent what the dollar is doing and the strength there. It had a pretty decent day today.
Yeah, and obviously, I mean, normally that we, the fact that the 10-year yield didn't go anywhere is sort of surprising because the dollar often rises with this. It depends on what other yields around the world are doing, and obviously the short-term yields were rising. But it is interesting, the dollar rising quite a bit. That's not a great sign for U.S. profits, especially the multinationals. The ones that would trade, on the stock exchanges.
Mhm.
So that's another reason why stocks have been struggling this week.
Yeah. Let's go ahead and round out and take a look at a couple of the sectors, and maybe we start with the industrials. Kind of a mixed bag here. It's been showing some weakness. XLI is the sector spider fund ETF for industrials, but it's still, to its credit, holding that 50-day line.
It's holding that 50-day line. It sort of popped out in a look. It looked good yesterday, and now it's come down. Now it could bounce right back up. It's not broken. It's just one of these frustrating things. So there's so many examples of stocks that look like this,
Hmm.
that moved out, say either Tuesday or Wednesday, and then fell back. The relative strength line, that didn't fall because the indexes fell 1% plus. So the RS line is still at a high. I mean,
Right.
it's definitely something you want to watch. There's a lot of stocks in the industrials that look interesting, but it's just hard to make any headway.
And, like you were saying for RSP, you can see at least a little bit of an uptrend here. Instead of
Yeah.
just kind of flat along the lows, you are seeing some higher lows as that 50-day moving average line trends higher, and it continues to kind of find support there. What about over at the miners? XME is your metals and miners ETF. This one is struggling right there at the 50-day and 200-day moving average line. And I guess you can just add the 21-day in there too, because they're all
Yeah.
converged together.
Yeah, I mean, so again, this is one of those things. Wow, if this were a better market, we'd be going, "Ooh, look at that!
Mhm.
Look at that! Maybe this is going to go. You're going to have a trend line, a breaking through here." I mean, there's things you could be excited about, and there's a lot of miners or some steel stocks that are doing well. We just don't know. I mean, this is one of those situations that 3 weeks from now, it'll in hindsight, everybody will say, "Oh, it was obvious this was going to go up. Oh, it was
Right.
obvious it was going to go down." It's like it's not. It's not, and
It's
it's
obvious
something.
after the fact.
It's
I'm
yeah.
really good at that.
Yeah. I can look at a chart and say, yeah, look, it's going up from the hindsight. This is definitely one to watch, but just another one that there's just a lot of watching. And so I'm going to sit back and wait. It doesn't mean just sit on your couch and do nothing, clicking your remote. I mean, go through your charts, go through things, get watch lists, get ready because there are a lot of things that are right there by buy points or just a day or two from being at buy points.
Yeah. And of course, we have to kind of also talk about energy. XLE is the energy sector spider ETF. And, energy, of course, was the darling of 2022. You kind of look at the best performing groups of last year, and it's really filled with oil and gas. Where does it stand now?
It's not doing that badly when you consider like oil. Okay, it bounced a little bit today, but it's down hard in the first few days of 2023, and it's well off highs.
Hmm.
So it's a little blip. USO is sort of somewhat tracks the spot price. It's not. I mean, the spot price is in the 70s, but new and natural gas has just been absolutely crashing. So
Right.
oil is weak. Natural gas is at a 1-year low, and honestly, it's sort of surprising how well some of these stocks have done in that context. But
Mhm.
you get it. That's sort of a moral victory kind of thing. But it needs to get above the 50-day line. So you need to see a little more strength in oil and maybe natural gas at least stabilize for this to really make a move.
Yeah. Let's talk stocks. You mentioned there's a lot of stocks out there that are setting up, and one of them is United Therapeutics. UTHR is the ticker symbol on this one. And we've been seeing a lot of biotechs that have been showing setups, some strong moves that they've had, and they've been kind of consolidating the gains. And here we are, right there at the 21-day moving average line. That 50-day line is really rising up to kind of meet it while it does this flat action. Is there a potential entry here?
Well, on the one is that there is this downtrend line that you could probably do as an early entry using a trend line or using this high here, sort of that. On a weekly basis, just to show this, the 50-day line is catching up. The 10-day week line has caught up. The 10 week is
Hmm.
basically around where the 21-day is, and it's really traded tightly. And even within those weeks, it's been tight. So the weekly
Yeah.
closes have been tight, but it's even better, and they've closed near the highs of the range for the most part. So 5 weeks tight, you could sort of treat this as a flat base. Just get above, that would be the official buy point, would be getting above this area here. So definitely some nice action. Just, you know, it moved up on a breakout, held that breakout, traded very tightly, a lot to like at it. Now, we've seen other stocks that hold up, hold up, hold up, and now they start to weaken. So
Hmm.
definitely an issue. But I think that there's definitely, this is definitely one to watch closely.
Yeah, and I mean, certainly the fact that it's traded so tight while the market has come down has led to that strengthening relative strength line. What about over at Train Technologies, ticker symbol TT there? Now we're back into the industrials. What what do you make of TT's action?
That one's doing pretty well as well. Holding at the 50-day line, 10-week line, relative strength. Look at that, flat, 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 flat at highs, and now moving up, even as the stock hasn't done that much. Uh, this is a long, deep cup with handle, which deep, deep, deep cup with handles are not necessarily ideal, but this handle is long enough to be its own base. So you could treat it that way.
Hmm.
I suppose if there's a strong reaction, trying to look for early entries, if it broke strongly higher, maybe clearing yesterday's high, that could be an early entry, obviously, but that's the kind of thing that's been looking like something that goes and then it can reverse lower. So that's what you have to watch out for. But I think this has been showing strong action, solid earnings growth. Both of these stocks, solid earnings growth, not wow earnings growth, but
Mm.
in an economy that's sort of weak with labor costs soaring, solid growth is pretty good.
Yeah, I mean, even if you're getting double digits in your estimates, I mean, that's that's a lot better than a lot of these that are kind of showing negative action, showing some red in there. And as you mentioned, that base, I mean, 41% is usually deeper than we like to see, but when you tack on a handle there that has a 9% depth, and this is where hovering over the market smith charts, it gives you that data on the pattern recognition, which really kind of helps do the calculations for you.
And you could also treat this as a bottoming base here.
Yeah.
Like this was a bottoming base within, and now it's just forming another base right on top of it. It's almost a base on base, really, in some ways.
Mhm.
So from that perspective, and where it's not showing that, it gets a little bit confusing. But so from that perspective, it found support right above, right at the top of that old base. So that's the place you would expect it to. It all sort of lined up together. So um, that also provides a little bit of encouragement. It moved out, found support, held the relative strength line, and the RS line is continuing to move higher.
Hmm. So some decent setups there, but we got to talk a little bit about sector rotation because when you look at Cigna, ticker symbol CI, this was one that was doing so well. It was holding above that 50-day moving average line, seemed to be everything going its way, and now the last few days have not looked pretty.
Yeah, the group has really fallen apart. They're all sort of looking like this. I don't know all the reasons why. I mean, I saw some contracts being announced and talking about what I meant for 2024, but it was hard for me to judge. But all I know is I can see this, and I can see
Yeah.
this with a lot of these names falling through. Okay, falling through the 50-day line. It's like, well, if you bought it here, it's like, well, maybe you still hold it because it wasn't decisive. But then yesterday, really negative, and that's also when the market was ended up
Hmm.
higher. Really sharp losses, really, for a week for a group that probably shouldn't. They sometimes have those moves, but I mean, this was a wild, crazy move. That was a wild day, but otherwise, that's a really steep sell-off and wiping out a lot of these gains from sort of this area. Just disappointing, especially you expect a defensive growth group to do well in this kind of environment, or relatively well. Like it's going to do better than some of these high-flying growth names.
Right.
Uh, but not. And I think that's another lesson is like we've seen solar stocks, they were looking so strong and then they fell apart. And now health insurers, they're looking strong and then they fall apart. So it's one of those situations that's not just this individual stock volatility, it's not just the market volatility, but we're still seeing the sector rotation. So, even if the market goes sideways, you can be in stocks that suddenly fall off quite sharply, and and you have to react to that.
Right. And it's as you said, it's not one of those things you don't always know the reason behind it, but you don't want to, stop and do nothing and not react because you don't know the reason. Sometimes it's, sometimes your reason is just looking at the chart. And certainly that sector rotation has been one of the issues that has made this a little bit more difficult, when they just kind of pull the rug out from under you, something that's doing well, and then all the gains get lost so quickly, because a lot of times the gains haven't been that much to begin with, so it's very easy for them to get taken away.
Yeah, and if you rotate, if you're in a strong uptrend and you have sector rotation, so then a group starts to lag a little bit, but still rises, or just goes down a little bit after rising, 20, 30%, that's a much easier thing to handle. It's when you go up 5% and then fall 15. That's the kind of sector rotation that, just kills a portfolio.
Absolutely. Well, thanks a lot for that analysis today, Ed. As always, a pleasure having your insights. Now, for us, we are about to start our Swing Trader scorecard. So for those of you that are members of Swing Trader, you can join us over there fairly soon. We're going to be starting that at 1:30 Pacific time. And tomorrow, we're going to be starting all this back up on IBD Live, doing the analysis 10 minutes before the opening bell. If you haven't checked that out, you can go to www.investors.com/IBD Live to give us a trial and see what the analysis looks like on a more extended basis during live market trading. We start 10 minutes before the open, and we go a full hour and a half into the action. So please join us for that. And Ed and I, we're going to be back tomorrow on the SMT video, Stock Market Today, to wrap up the week and see what happened with this jobs report and get Ed's analysis on that. So hope you join us for that. Thanks for watching today. We'll see you next time.